Why? Why buy?
You know, it mainly has to do with the size of this category. I mean, I think we all see from our own usage, this has been transformational. Anytime we get one of these companies in technology that becomes a verb, I'm going to Uber over, it tends to be a pretty good investment as well. Doesn't mean it's going to be a straight line. We've seen a lot of that kind of volatility across these companies before, and Uber's got a lot of ground to make up in terms of profitability, but we think over time it's going to be the right call.
And yet, looking here at your note, it says that one of the key risks to Uber as an investment is its business model. What do you mean by that?
Yeah, so this is a category that right now has a lot of subsidies going to drivers, going to riders. We're in this sort of sugar rush period where the business model has been, let's subsidize these things so that we can drive supply and demand on both sides of the marketplace. That's been a big part of the volume. One of the things that we also say in that note is that it's time for the sector to grow up. And so we think that there's going to be this sort of transition period as consumers and drivers kind of get weaned off of all these subsidies. We estimate not just Uber, but $9 billion worth of venture capital being burned in this category in 2018 alone. That's going to have to change. That's not sustainable.
So no more 30% discount emails? What? Yeah. Fare hikes? What?
You'll see some of those, but fares are going to come up. We've seen that already. One of the things that we looked into in the report that we did was the impact that fare increases have had. You see it especially here in New York City between fares going higher, regulatory fees being applied. It's costing about 25% more to take an Uber somewhere this year versus last year. And so that's one of the reasons that you've seen Uber's growth slow. It's one of the reasons that you're seeing growth in the category as a whole, with Lyft beginning to slow. And so investors are just going to have to expect that.
So we had this discussion last week. Is the core driving business closer to profitability than maybe they got credit for going into the IPO?
Yeah, I think that's definitely true. I mean, I think when you separate out the different markets and the businesses that they're in, there's so many different things that Uber's doing, between the Eats business, which is obviously losing a lot of money right now, the investments that they're making into autonomous. This week they have this big conference around Elevate and what they're doing down in DC there. So they're spending a lot to make this a platform and not just a ride business.
How does your take on Uber compare to your take on Lyft? Are they both buys for you right now?
Well, we've got a neutral rating on Lyft, and that's largely a function of the fact that the stock's actually done so well going into when we initiated. I think a lot of what makes Lyft interesting as an investment is its simplicity. It's U.S. only, so they don't have to deal with competing against all the international competitors that Uber has, and they're not in the food business, which right now is just incredibly competitive with all the venture capital that's going into that category.
Looking across your coverage universe right now, certainly we saw tech come off, and now it's really rallied again. What is your favorite stock, favorite pick, why?
Yeah, so top of the list for us still is Amazon. I mean, and I think you guys are probably tired of hearing that because we've been saying it for so long. But the reality of it is we're going into 2019 already at this point having seen more retail store closures announced in the first 4 months of this year than we saw in all of 2018. The last time we saw that record set in 2017, it turned out to be a huge catalyst for e-commerce growth, and we think that that's going to be the case again. So it's a little bit of a dark reason, but it is going to benefit Amazon's retail growth. And if you look at what consensus in the stock is implying, no one's really expecting that kind of retail growth accelerating in the second half of this year.
Should investors be paying closer attention to all the transportation goings on with that company? I bring it up because of the FedEx news on Friday that they're not going to renew one of their contracts, the U.S. Express contract with them.
Yeah, you have to pay attention to that. Obviously, it's a key component of how Amazon gets product to people. It's a little bit of a lagging indicator, I think, though. Okay. Amazon bought 30,000 Sprinter vans last year to replace a lot of what FedEx and UPS do for them. That 30,000 is nearly a third the size of FedEx's fleet in the U.S., so it's a big investment. So their reliance on FedEx is a lot less than it used to be, and it's obviously going to get a lot lower.